Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 8.02% year to date. Here at Spy Trader Now, we try to beat the returns of the S&P 500 buy and hold investor, and we do that by using a 3-position portfolio. Very simple. So we either have shares of SPY, we buy the ETF, symbol SPY, we do options, or we're in cash. Currently, this is our portfolio allocation. We are not accomplishing our goal right now because the buy and hold investor is currently up 15.79% year to date. So we have a little bit of work cut out for us to beat that return. So that is our goal. Let's see if we can do that before the end of this calendar year. Here are some past returns for Spy Trader Now. See, the last 3 years have been very good years, especially 2020. Last week, the S&P 500 lost 0.13% for the week. Okay, so here are last week's trades. So what happened was on September 14th, my 2 options that I had got assigned. So my shares and my option got assigned, got taken away from me, and my trades and my account balance reflect that. And on the next day, which was Friday's trading action, I sent out this to my subscribers. Hey, my option was exercised and my 200 shares were called away. I'm now buying 200 more shares with no option on it. And I'll tell you why I did that later on in this presentation. If you still hold the shares, just simply roll your option out 1 week with the same strike for 20. That way you get a little bit of time premium. So here are some of the trades that I've made and the more recent trades. I have one open trade right now, which is the ETF, which I just call stock. So it's I have 200 shares currently, and these are 2 losing trades. That's why they're in red, because I got whipsawed at those 2 times in the market. Anyways, so this is where we stand with our portfolio. If you want to see all my trades going back for the last 3 years, you can head over to spytradernow.com. There'll be a link down below in the description. Everything that I'm presenting to you today, you can go to the description for all the links for all the different pages I'm going to show you. Here is the equity curve for our model portfolio for 2023 year to date. Here is the equity curve for the S&P 500 buy and hold strategy. And here are the 2 equity curves combined, because we want to compare our model portfolio against the benchmark of the buy and hold investor S&P 500. And we want our blue line to beat this pink line. We have not done that yet, so we want to do that. Here is the Fed Chair, Jerome Powell, and here are the interest rate hikes he's made in the years 2023 and 2022. Last rate hike was done on July 26, 2023, 25 basis points. Now, the next announcement will be on September 20th. Well, guess what? That is Wednesday of this week. The expectation is that the Fed is going to skip on this announcement on Wednesday the 20th. But he's going to say an announcement with that stating how dovish or hawkish he is on interest rates. So we have still 2 more meetings till the end of this calendar year. I'm thinking that we're going to get a 25 basis point rate hike in November, and then he's not going to do anything in December. And that's 2023. 2024, he's not going to want to do much because it's an election year, and normally they don't want to skew elections. So we'll see how this plays out. We'll know more after Wednesday from this announcement. Now we're looking at things from the presidential election cycle theory, which states depending upon the year of the election, historical rates of returns, we have the average historical rates. President Biden is in the 3rd year of his election cycle, 2023. Normally that equates to a 16.3% return. Currently the buy and hold investor is at 15.79, very close. Now we're looking at things from a bond market outlook. From the bond market outlook, it's telling us to stay out of the stock market because we have an inverted yield curve and we have rising interest rates, both negative for equity investors. Now we're looking at things from a valuation standpoint according to current market valuation, CMV, link here and in the description down below. We are overvalued by 53.6% above the modern era average of 20.2% for the PE. So that puts us at 1.4 standard deviations above the average. So there's risk in this market. Caution is advised. Now we're looking at things from the CNN Business Fear and Greed Index. This is our friend Warren Buffett. And right now we're in the neutral territory on the Fear and Greed Index. 1 week ago, we were at 51, so staying about flat neutral. This market can go in either direction. Now we are looking at things from a seasonality outlook. Currently for the month of September, we are down 1.2% for the month. This is the summer doldrums, these 3 months, August, September, and October. Currently we are in September. So that is where we stand from a seasonality outlook. Now, this is a long-term outlook. This chart is going back 20 years. It's a monthly chart of the S&P 500. We are bullish as long as we stay above this long-term support line and this line right here. And currently, we are above both of those lines. So from a long-term outlook, we're bullish. Now we're looking at things from an intermediate term outlook. We're going back 5 years. Weekly candlestick chart. You can see that we're reaching we're in a trading range between these two lines here. And right now we have not surpassed this old high. Until we surpass that old high or go lower than that low, we're in a trading range between these 2 points. Now we're looking at things from a short-term outlook. This is a 6-month daily candlestick chart of the S&P 500. And you can see that trading range a little bit more defined. So a tighter trading range would be between this high and this low, or you could extend it from this high or this high to this low. So we're in this range right now until we break out of it. Now, I put a red arrow here next to 420, which is a little greater than 8%. It's about 9% below the all-time recent high of right here. And I'll show you why I put that arrow there later on. Now this is a ratio chart. We're monitoring this to see how well the normally weighted S&P 500 does against the equally weighted. RSP is the equally weighted, SPY is the normally weighted. So the ratio chart is the one that's in black and red. The two other charts are the normally weighted in blue and the equally weighted in green. During normal bull markets, the equally weighted surpasses the normally weighted by a little bit. Currently, we're dead even. As a matter of fact, the normally weighted is even below the equally weighted, the equally weighted is below the normally weighted right now. We want the MACD to be above its signal line. We were coming down and it looked like we were going to cross below it, but we never did. We are currently going parallel. It would be a negative condition if we were to cross down below its signal line. So we want to monitor that. The last time we did this, came up and then crossed below it, you can see that the stock market, which is this blue line, took a pretty good dive right there. Now we're looking at the fear index. Now we are in this ultra low trading range, and when you're in this ultra low trading range, this chart is supporting more up to sideways action. The black line is the S&P 500. Now if we start to jump up and come into this trading range, the S&P 500 is going to lose some ground like it did between here and here. So we are monitoring this. Okay, right now we're looking at the Thinkorswim platform with the S&P 500 SPY 1-year chart with standard deviations of +2 and -2 in gold, +1, -1 in pink, regression line dash green. We currently reside at -0.3 on the standard deviations. So we're monitoring this, but we're right about in the middle, very close to the regression line on the 1-year chart. Generally speaking, this is a bullish chart. Why? Because when you look at the regression line, at the standard deviation lines, and you go from the left side of the chart to the right side of the chart, you're heading up or north, and that is bullish. This is the same chart except it's going back 6 months. Same thing, bullish. You see an advancement from the left side of the chart to the right side of the chart. You can see I've got a measured move in here with the 127 and 161, and I'll show you that in the next slide. But here on the standard deviations, it is at negative 0.8. So here you can see the 127 and the 161 on this measured move right here. We did tag the 127, but we never tagged the 161 on this measured move before the market came down. But right now, where we currently reside is at negative 0.9 standard deviations, which is very close to the -1 on the 3-month chart. This is a 3-month chart. And here you can see that the standard deviations lines, instead of going more north like the 1 year and the 6 month, they're flattening out. So the market is clearly flattening out now in this last 3 months. I got some alerts to be sent to me. One is at this old high here. One is at approximately this old high here at 458. So this way, if the market starts moving and I'm not looking at the market, I'll be alerted to let me know that the market's moving up in this case. Also, I have an alert at this low right here, which is part of that measured move, to determine if we break below 435.49. All right. That is the presentation. I just gave you a ton of information. Now comes the critical thinking. What are we going to do with that information? Well, as of September 17th, 2023, the market summation, according to me, your host Ken, with SPY Trader Now, the market is stuck in a trading range. I currently do hold 200 shares of SPY with no option. If the market goes up to 453 to 458, somewhere between those two upper alerts I sent you, that I showed you on the previous slide, I will sell an in-the-money covered call with a 420 strike and an expiration date of 9/29/23, so just about a week and a half or 2 weeks out. Overall, I am expecting weakness till the end of October and then strength till the end of December. Now, why am I waiting for the market to come up to sell that in the money covered call? Because if the market comes up, that in the money covered call is going to be more expensive, meaning that when I sell it, I'll put more money in my pocket. And if I am correct and the market does come down into weakness till the end of October, my expectation is to buy to close that in the money covered call that I purchased and bank all that profit. So that's what I'm trying to do, and I'm using the seasonality and everything in order to do that. So I did try to place a conditional order with my broker, and this is what a conditional order would look like. When the last price of SPY is greater than or equal to 458, then the broker automatically would perform this action: sell to open 2 contracts of SPY with September 29th, 2023, 420 strike price, covered or call. In this case, it's a covered call because I own 200 shares. And I went to place the order, hit review order, and then this came up. The system is temporarily unavailable. So I couldn't place my conditional order to make this all automated for me. So I'll try to place this on Monday during normal trading hours. We'll see if that goes through. But either way, I do watch the market closely, but I just wanted to automate my trade so it would just happen automatically for me. And this is what that would look like if the system was actually working properly. Anyways, I hope you got some valuable information out of this video. If you have not done so already, go ahead and hit that subscribe button down right there. Ring that bell to be notified. Smash that like button down for me. You can head over to spytradernow.com to learn more about me and my trades and trading style. And that's it. That will wrap up this video. I wish you good trading.